Hey folks, Frank Zorilla here, November 25th at zortrades, 2 o'clock, coming from Zor Capital. Want to do a quick video here in regards to the market. IBD but put the market this weekend back into a confirmed rally after 5 consecutive up days. You know, some hardcore IBD guys might say, hey, the Nasdaq is trading below a declining 50-day moving average and it's trading below the 200-day moving average. But the fact of the matter is, I mean, over the last couple of years, the market has changed somewhat, where anytime we had some type of free fall, I mean, the market just goes straight up after that. So, you know, you can't blame them. But either way, what I want to look at today is, you know, where at certain times breadth becomes so good that it's actually bad, and also there are other times, like for example last Friday when the market was down the drain, everyone was jumping out the window, when breadth is so bad that it's actually good. So on the 16th of November, you have roughly, whatever it was, 15% of stocks trading below the 40-day moving average. You had the MAC oscillator actually, you know, negative 300. And normally when you get those type of numbers, you always have people say oversold can become more oversold. But the fact of the matter is, from a probability standpoint, the market normally bounces unless you get some type of crash or 1987 type situation. So it's all about the probabilities. Now we have a market that's up roughly 5 days in a row. That normally, these indices, the ETFs, are normally mean reverting vehicles. So in a strong market, you might see the index up 5 days in a row, and you might see them consolidate. But what you normally see is stocks setting up, and stocks continue to move with the market, you know, up 5 days in a row. I don't think that's going to be the case here in the short term, but you never know. So you have to be ready for both sides. What I'm looking at is very simply the spiders, the S&P 500 up 5 days in a row. You might have some resistance here at the 142 level. It's got a declining 50-day moving average, and as of Friday, you have 89% of the stocks trading above the 10-day moving average. You can only get to 100. So normally you might get some type of consolidation, which will correct, you know, the overboughtness via time, or it might be price. I'm betting that it's going to be price. And if the market opens up on Monday, the probabilities become even higher that you get some type of short-term pullback. And if you look at the spiders, if you dig in and take a look at some of the S&P sectors, S&P 500 sectors, you'll see that it's actually very overbought. If you take a look at the XLF, the financials, the most important one in the index, up roughly 5 out of the last 6 days. You had one flat day right over here. It's right at the 50-day moving average. You have roughly 95% of the stocks within this XLF ETF trading above the 10-day moving average. You might have some resistance here at this lateral trend line, descending trend line. You know, for those guys who are hardcore, you know, mean reverters, or like to short, or like to hedge, you know, this might be a good shorting opportunity on any type of gap up on Monday. As you see the volume here, it's declining. Yeah, it was a shortened week, but then if you say that, you're just justifying, you know, exactly what happened. Next, you have the XLB, another S&P 500 sector, lateral resistance level here, roughly 3650, up 5 days in a row, and you have 100% of the stocks within this ETF that's trading below its 50-day moving average, trading above their 10-day moving average. So 100% of the stocks within this ETF are trading above the 10-day moving average. Next, you have the XLP, lateral resistance here roughly at 3580, up 5 days in a row, and you have roughly 97% of the stocks trading above their 10-day moving average. You have the XLV, where you have 95% of the stocks trading above their 10-day moving average. You have the XLK, which is just pretty much Apple, so disregard this one. But the point of the matter is that normally sometimes breadth gets so good that it's actually bad, and what I like to do is very simple: take extreme breadth and try to connect it to some type of technicals or some type of resistance levels if it's on the overbought side, or some type of support levels if the breadth is extremely oversold. And right now what I'm looking at is the S&P 500 being extremely overbought, not only as far as the spiders themselves, but also the sectors within the SPY. So either way, be on the lookout for a possible pullback. Trade them well and be well.